What is going on, guys? Nick here, back with another video. Disney reported earnings on February 8th, and overall, it was definitely a really strong quarter for them, showing a lot of really good progress. Disney stock saw a pretty good drop during 2021, but they've rebounded pretty well since the beginning of 2022. So let's take a look at what's going on with the company, what changed over the past quarter, and what the stock is worth now. So first, streaming numbers came in very strong after adding 12 million new subscribers during the quarter. And since in their previous earnings report, the subscriber count came in a little light, a solid bounce back shows that Disney Plus is no surprise in good shape. Disney also says that they plan to invest even more in streaming towards content, which includes a bid for the NFL Sunday Ticket. Now, Disney Parks also saw a pretty good bounce back with revenues at $7.2 billion versus $3.6 billion in the same quarter last year. They were able to return to profitability with $2.5 billion in operating profit versus the $100 million the parks lost last year. As the parks do start to bounce back, it's really going to help Disney out by adding a big chunk of their lost profits back. Now, during the earnings call, Disney did mention that the Disney parks in Florida still haven't seen a return of the international travelers. Those international travelers accounted for about 18% to 20% of their guests in the past, so there's still definitely plenty of upside for the parks to recover. Disney also said that they're still experiencing productions with TV and film production, and that while their theater releases were some of their best films of the year, that movie theater traffic is still down, making it much harder for Disney to turn a profit here. So Disney reported earnings of $1.06 adjusted versus the 63 cents expected, and revenue came in at $21.8 billion versus $20.9 billion expected. Disney Plus subscriptions came in at 129.8 million versus 125.8 million expected, so there were very solid beats across the board. When we look at their trailing 12 months worth of earnings from each quarter, we can see the most recent quarter reported in red was a pretty substantial profit for Disney, showing the recovery is still going well. Looking at the past 10 years of revenue and income for Disney, we can see that things have definitely been tough since 2020. Still, we can see that Disney continues to grow their revenue and has recovered nicely since then, so things are definitely looking up for them. Now, Disney changed how they report some of their segments a bunch. The two major segments are their media and entertainment, which are all of their TV channels, movies, and Disney Plus. The parks business is obviously the parks, but what we can see is that media and entertainment has actually been dropping over the past few years. In 2019, it made about $8.3 billion in profits versus $7 billion in profits over the last year, but revenue has increased over this time. So because I was curious about what was going on, I made a second segment chart showing the media segment broken down. So we have the TV segment in blue, direct to consumer, which is mostly Disney Plus, in green, and the content licensing and sales, which used to be called their theater segment, in red. We can see that TV hasn't really shown any growth since 2019, and 2020 was actually its best year over the last three. While they did record 125 million subscribers, Disney Plus is still actually losing about 1.8 billion per year. Now, for comparison, Netflix hit 125 million subscribers in 2018. In that year, they brought in about 16 billion in revenue and 1.2 billion in profits. Now, these are net income numbers, not operational profits like you see for Disney Plus, so it's not a perfect comparison. However, I'm not sure that Disney is very pressed to make Disney Plus profitable yet, and streaming is Netflix's entire business, so this might not be a great comparison, but it is still pretty interesting to see. When we look at Disney's current forecasts, analysts see a pretty strong rebound going forward. Disney is expecting to recover their revenue and profits, going from 73 billion in revenue and 3 billion in profits over the last year to 102 billion and 12 billion in profits during 2024. When we look at revenue growth, the company is projected to slow down by 2024, growing only by about 11 and 8% during these years. However, looking at net income growth, since the parks business should gain a lot of profit growth and Disney Plus will likely become profitable in the next couple of years, the current projections are between 29% and 22%. Now, what makes this valuation very tricky is there are a lot of moving parts here. Also, there's probably going to be a multiple adjustment with the changing business. Historically, Disney has traded around a PE of about 14 to 20, which, using my PE reverser tool, gives them an expected growth rate around 4 to 9%, which is definitely too low for them going forward. My guess is Disney will and probably should get a bump to around 12% to 16% growth. My thinking is while the parks and Disney Plus will boost profits, the parks business can only recover to 100% of what it was, and then it continues growth at what it saw in the past. Now, Netflix's growth is slowing down around around 200 million subscribers. However, since Disney Plus has more international appeal, I think they are going to pass that number. So my guess is that they'll start to slow down like Netflix has once they hit around 250 to 300 million subscribers. So a growth rate of 12% gives us a fair PE value of 26, and a growth rate of 16% gives us a fair PE value of 37. So this does put Disney in about its fair value range, with 2024 having an upside of about 21% for the low end of the range and 73% for the top end. Now, this earnings multiple is up from where I valued them in the past, and I think the issue was that I needed to add a little more of that profit growth in. There were some people who said that Disney should trade at the same multiple as Netflix, but I really don't agree since we're using an earnings multiple and not a total valuation. Now, this is hypothetical, so don't take it and run with it, but if we said since Netflix has a market cap of 137 billion, then Disney Plus should add around 200 billion to Disney's valuation. I do think that that's a much more logical argument to make, but that's not the same as saying that Disney should trade at a PE of 30 to 60 just because that's what Netflix is traded at. For Disney to justify the same earnings multiple as Netflix, they would have to grow their entire business just as fast. So when we look at Netflix versus Disney's profit growth, we can see how different the two of them have been. Before COVID, Disney was growing by around 8 to 15% on average, while Netflix was having a bad year if they only jumped by less than 50%. So that's just a little explanation for you guys. Thanks for watching all the way to the end, but before you go, make sure you check out this great video I have for you next, and as always, thanks for watching.